Hello, welcome to this week's Private Funds Update. I'm Sandra from SmartEsq, and today is Thursday, June 11th, 2026. Let's dive in. We begin at the Supreme Court, which just handed the SEC's Division of Enforcement a unanimous decision that the agency may continue to seek the disgorgement of ill-gotten gains without being required to prove specific pecuniary investor loss. For years, defense counsel have actively sought to limit the SEC's disgorgement powers, arguing that under traditional equitable principles, the agency should only be able to claw back funds to the exact extent that victims were financially harmed. The Supreme Court formally declined to impose that limitation. For private fund managers, this ruling is critical. It means that in cases involving technical footfalls, such as an undisclosed conflict of interest, or an improper fee allocation where the GP profited, but the LPs cannot definitively prove they lost money, the SEC retains the authority to demand full disgorgement of the manager's profits. If your compliance program operates in the gray areas, your financial exposure in an enforcement action just remained at its absolute maximum. Turning to fund structuring, a significant tailwind is building for the retailization of private markets. In Release IC-36165, the SEC has signaled a clear path toward monthly liquidity for registered interval funds. Historically, under the Investment Company Act, interval funds have been functionally constrained to offering periodic repurchases on a quarterly, semi-annual, or annual basis. This new framework explicitly paves the way for monthly repurchase offers, provided the fund meets specific enhanced liquidity risk management and notification standards. For private fund managers looking into more capital access through interval funds, this is a game changer. It allows you to build continuously offered retail alternative products with a liquidity profile that directly competes with traditional mutual funds, without fully sacrificing the closed-end structure. Finally, looking across the pond, we have a rare instance of regulatory burden reduction. The UK's Financial Conduct Authority is officially consulting on plans to simplify climate-related financial reporting for investment products. Acknowledging the heavy compliance costs associated with the existing Task Force on Climate-Related Financial Disclosures, or TCFD regime, the FCA is proposing to streamline product-level metrics and remove duplicative disclosure requirements. The regulator estimates these targeted changes will save asset managers roughly £20 million annually. For US-based sponsors marketing into the UK, this signals a pragmatic shift, ensuring your European ESG compliance budget won't face infinite upward pressure. That's your briefing for this week. You can learn more about these topics from me on the SmartEsq platform. If you are curious about the services we offer, please visit www.smartesc.ai.